Okay, let's get started. Welcome. I'm Mary Ellen McGonagle, and I'm the founder of MEM Investment Research, and I'm delighted that you could join me today. I look forward to teaching you about how to use moving averages, and this will really help you outperform the markets. And I'm going to share with you some of the key ways that you can use these moving averages, and this will provide you with a guide that you can work from. And more importantly, I always say this, it will provide you with the confidence to pull the trigger to either buy or sell your stocks when the key elements that we're going to be discussing hit your screens. So let's go ahead and we can get started. I can like to provide you with a bit of background as far as who I am. Again, Mary Ellen McGonagle. And you know, when I was younger, growing up, I really didn't know much about the stock market or really even Wall Street. I always did have a love of finance and numbers. Right out of college, I moved to New York City. And in a stroke of luck, I met someone who had just started their own executive search firm, and they helped me secure a job as an assistant on the trading floor at Goldman Sachs, and it was a truly very, very exciting period of time for me. I was certainly low man on the totem pole, but the excitement, huge amounts of money being traded, it was really a very, very exhilarating time for me and a great platform. I did leave Goldman Sachs and joined a large institutional insurance firm as an assistant portfolio manager. So I went to what's called the buy side. I did move up there to a position where I was eventually managing over $2 billion in fixed income. And it was, again, another great experience. It was the insurance company was very highly regarded. The firm managed over $6 billion, which at the time was considered quite a bit of money. And the reason I'm pointing this out is because being with this large institutional firm, it really was the first time I was given the experience of seeing how, being a big money manager, you had access to important information before it trickled down to individuals. And the access to this key news was really an advantage, but luckily that is not going on these days. The SEC, of course, as you know, stepped in and they put a stop to most of that. So now the playing field is, it's a lot more level. And as an individual or self-directed investor, I think it's a very, very exciting time for you over these last few years to be able to have access to this key information at the same time. So it really gives you the ability to not be behind the curve. And if you, as an individual investor, you know where to look, you've educated yourself on trading, you can easily outperform the markets. The other key advantage for the self-directed investor is that you can be quite a bit more nimble. You don't have to, getting in and out of positions is with ease. You're not moving the markets. So again, really an exciting time for self-directed investors. So for years when going forward, I did leave that buy-side firm and moved out to the West Coast with my then new husband, and I joined William O'Neill and Company, which provides investment research. They have Investors Business Daily, for those of you familiar with that. I was with the company, but on the institutional side, which means I interfaced with top portfolio managers and analysts throughout the world, a lot of well-known portfolio managers. In my position there, I was advising them on the broader markets as well as on stock lists that they would provide to me. I would alert them when their stocks look to be in a buy or a sell position, and that was for over 15 years, and again a very exciting time. I was there for through the internet bubble in 1999 when tech stocks were soaring, and then that subsequent crash. I was there also for the '08 banking crash and then the subsequent recovery. So I've been through quite a few cycles and have quite a bit of experience as far as what moves a market and what areas, how to identify a leading stock and so forth. More recently, I have started my own company, MEM Investment Research, and I provide with that a weekly newsletter as well as a midweek update report. And I do still work with several institutional firms, but I've opened it up to self-directed investors for MEM Investment Research. If you are interested, you can always visit my website for a little bit more information. So let's go ahead and move on. I just need to show this disclaimer. I'm not going to read the entire thing. Probably the most important here is that the presentation is for educational purposes only. It's not a recommendation to buy or sell any individual securities. So I'd like to begin with giving you an overview of what we will be covering today. The first item is a definition of a moving average. We'll review exactly what a moving average is. And then from there, we can dig into which ones, and when I say ones, which moving averages do you need to pay attention to? And it will be different from investor to investor depending on your time frame. If you're a day trader or perhaps you have a more medium to longer term outlook, we'll review the different moving averages and which ones would be applicable depending on your style of investing. The next item is how you can pinpoint when to buy or sell, and there are ways to determine if you own a stock that is poised to outpace the markets using moving averages. We'll cover those, and then we'll also show you stocks that if you own them you'll need to sell them, or they can be possible shorts, again using moving average. This last, using history as a guide, we're going to be reviewing several examples of past stocks, winning as well as losing, and again really pointing out how these moving averages can get you in front of stocks before a big move or make sure that you exit a stock and preserve your profits. And then this last item, at the end of the presentation there will be a special offer, so I urge you to stick around and you can take part in that special offer. So let's go ahead and start at the very beginning. I mentioned to you that we're going to review exactly what a moving average is, and then from there we'll review the various ways that these moving averages can really help take your trading to the next level. So as a definition, basically, before we get into that, I was going to explain that moving averages smooth out the price action of your stock. What they do is they filter out the noise and they form a line on your chart, and then this line defines the current direction of your stock, but then it also has many other uses that we will go into. There are two types of moving averages. There is one, a simple moving average, and then also there's what's called an exponential moving average. And so for today's webinar, we're going to be using simple moving averages, and as I explain the difference between the two, you'll see why. A simple moving average is, as the name implies, a simple, or it's also known as an arithmetic moving average. It's calculated by adding the closing price of the security for a number of periods and then divides it by the total number of time periods. And hopefully that's not confusing, but as For instance, if you are looking at a 10-day moving average, this calculation would take the closing price of that security over the last 10 days and then divide it by the number of 10. So quite simply. So what you'll see is that these shorter term averages, such as a 10-day, these are going to respond quickly to changes in the price of the underlying stock, and then longer term averages, for instance a 200-day, are going to be a bit slower to react. However, both long and short-term moving averages are very valid. They each have their place in trading, and we will go ahead and review that. On the other hand, exponential moving averages, this is a type of moving average. It's similar to a simple moving average, except there's more weight given to the most recent data. So this type of moving average does tend to react faster to more recent price changes. The exponential moving average is used in several indicators, such as the MACD, if you're familiar with that, or what's called the PPO, the percentage price oscillator. The exponential moving average also is used by some day traders when looking at intraday charts. Again, it does have that faster reaction, so they're more interested in the exponential. But again, we will, for today, be focusing on the simple moving average. For me, this presents a more true average, and it is better suited for pointing out upward support of the price of your stock or resistance, and we will be reviewing a number of examples. But let's go ahead. I talked to you about what different time periods and what moving average time period is going to be best for you as an investor. I mentioned briefly to you that the 10-day is a shorter, but before we get into each, I did want to point out the 4 moving averages that I have listed here are the 4 that I have found over my many years. These 4 have been the most useful. There are certainly others that will use a 20-day. They'll throw a couple others in there, but for my work, I have found these to be very helpful and key for finding stocks and certainly for trading. So the 4 that we're listing here, 10-day, 50-day, 100-day, or 200, these are the time periods that you will use on a daily chart. If you are looking at a weekly price chart, you will convert. The 10-day will no longer be useful, but that 50-day will become a 10-week. And then the 200-day will become a 40-week. So you want to keep the symmetry between the daily and the weekly charts so that you're looking at the same metrics for both charts. The other thing that I wanted to point out, and I would tell you this is a secret, but as far as determining the proper moving average that you should pay attention to when looking at daily or weekly charts, I have found over the years, I didn't mention it earlier, but part of my 15 years at O'Neill, and I continue to do it now, part of my job was to review over the weekend thousands of charts. I would get these huge database books delivered to my home, or if I was traveling wherever I was, and these 2 books would have 2,500 charts, and I had 2, and I loved every minute of it, going through each and every chart to determine where strength was, where weakness was, what groups looked good. So the bigger point is I found over that period of time, and even now, each stock does tend to have its own personality, and by that I mean they have certain moving averages that they'll pay attention to. But for the most part, these 4 that I've listed here, for 80% of the stocks, are the most valid. But you will find some where the 150-day is critical. It pulls back and bounces off of that. But as you review various charts, you will see that your stock has, as I said, a personality, and it's something that you can use to help gauge your response and how you think the stock will behave going forward. There's definite validity there. So, again, we will see quite a number of examples. This last item, there is one key characteristic that works in tandem with these moving averages when you're looking at the price relative to these moving averages, and that key component is volume. And in particular, as your stock price either moves above or below these key moving averages, you want to pay attention to volume, because the volume will be one of several indicators, but very critical, of potentially pointing you toward a trend change. When we see volume, it indicates institutions are in, particularly for larger names, and a lot of times they are going to be the guys that are going to move a stock. So you're going to want to pay attention to how your stock, if it trades above or below these moving averages, whether it does so on big volume. That's going to be something to look at. So let's go ahead. There are 5 key ways that I've found you can use moving averages. The first is to define an uptrend or a downtrend. And as we go through the examples, this again will make quite a bit more sense. But these moving averages can act as support or resistance. So if you find a stock that is in an uptrend and it continues to pull back to that moving average and it's finding support, that's going to tell you that that uptrend is still in place. And quite oppositely, if your stock breaks down below a key moving average, oftentimes then that moving average becomes resistance and the stock trades up to it and then bounces down. So that's one very, very critical way that we will review, and you can use key moving averages. Ideally, when buying a stock, of course, you want to see the slope of that moving average trending upward, because again, we're dividing the most recent those time periods by the price, and if the stock is moving upward, that's indicating strength versus downward. And number 2, as far as signaling buy and sell, I mentioned to you paying attention to the slope of that moving average, and then you want to see where the price of your stock is relative to its key moving averages. And we'll get into these again as we review these various charts. Determining broader market conditions, and really this is a very, very important use of moving averages. There are only 2 moving averages that over the years I've found useful, and that's your 50 and your 200 day, and then also using a weekly chart as opposed to a daily, and we'll get a little bit more into this, but generally this will help you from getting whipped around in the markets. You want to have a broader, bigger picture of what you're looking at when you're viewing the broader S&P indexes, the NASDAQ, and so forth. And these moving averages will really be critical in helping you define whether we are still in a continued uptrend or not. Let's go ahead, and I mentioned this earlier, to see if your stock is finding support. Is it bouncing off of that key moving averages and trending up? And then how we can use these moving averages to identify the strength or the weakness of your stock. I mentioned to you before, you want your uptrend to be in place, the slope of that key moving average, and also how your stock is behaving relative to these moving averages really is going to give you a sense of whether are you in the strongest stock. Is your stock exhibiting strength or weakness? So Let's go ahead and dig in, and this I think will really be helpful. We're going to review different examples, and hopefully you'll get a really good feel for how these moving averages can help you. So what we're looking at here is a daily chart of Intuitive Surgical. For any of you familiar with this stock, it's been a real big winning stock. This is a daily chart, so taking you back to mid-February and to current. So quite simply, we're looking at candlestick price history. Down below we have the volume. So I wanted to point this out to you and just show you what the difference is when you add. This is the exact same price chart that we just looked at, but now we've overlaid these key moving averages, again the daily. So this green moving average that is closely following the price of the stock, this is your 10-day, and I mentioned to you it's shorter term. It's something you would use certainly in these faster moving stocks. They tend to obey and pay attention to the 10-day moving average. The red line is your 50-day moving average, and then this blue line, I did put the 100-day. I've noticed that ISRG is more responsive to this 100-day moving average, and when it is such a fast-moving stock, the 200-day tends to lose its relevancy. So let's go ahead and take a look. I mentioned to you this is mid-February. As many of you recall, the beginning of this year was very, very difficult for the markets, but there were some stocks that really came out of the chute and revealed themselves as potential winning stocks before the rest of the markets, and ISRG was one of those names. I want to again take you back to this period back here, and if you will take note of how the stock price broke up through that 10-day and then up through the 50-day. One item that I did not mention before is a phenomenon when you have crossovers, both positive and negative, which can be very helpful. So the 10-day, when you have a shorter term moving average crossing up above the 50, so you have a shorter term moving average crossing above a longer term, that's called a golden cross, and it does tend to be a technically very positive signal for a stock, and we did have it occur here. So what we're looking at, and what I would like to point out to you, is here we have a stock in a confirmed uptrend. We talked about the slope. Your 10-day is very much in an uptrend. The stock is finding support. Now, this was a particular day in May where the stock, it was on a rumor, the stock traded below that 10-day, but you want to pay attention before you get shaken out and potentially fearful. The stock did the stock closed below that 10-day. However, you still had your longer term uptrend in place. The next following day, the price closed back above the 10-day moving average, and so your uptrend was resumed. So again, here, as you can see, it is very, very much finding support at this very upward trending 10-day moving average. So I talked earlier about how you can use these moving averages to really pinpoint buy points. So here we are, we're in a very fast-moving, strong stock, but you don't want to chase it. You want to get in, but you want it to be not extended. So what I did want to also point out is there are periods such as here, here, and here, where the stock is what I would call extended. So in other words, it's the current price at that point, it's separated. It's far away from this 10-day moving average. I'm pointing this out so that you don't want to chase a stock. You don't want to buy it when you see that type of distance. Basically what you want to do is you want to wait for the stocks to pull back to that 10-day so that it's in a more viable position. And there are actually two phenomena that will occur. Either the stock will pull back or the stock will trade sideways and the 10-day will eventually catch up to the current price. But either way, you are better served purchasing when that current price is close to that 10-day moving average. So let's take a look at some other time periods. I talked about when the stock breaks below the 10-day, and that can be concerning. For shorter term traders, you could use a breakdown below that 10-day moving average as a signal that perhaps things aren't going well. But from my work, I will tell you that you are better served using the longer term trend line as your guide. This is great. The 10-day is great for really helping you pick up buy points. There are periods when this initial break goes on, but again, from my work, as long as this 50-day is in an uptrend, you want to use the longer term moving averages as your bigger picture guide. So here, as a for instance, in this mid-May period, we did have the stock breakdown, but sure enough, it bounced right off of this upward trending 50-day. Now, over here, we're showing you the Brexit, and I will tell you that that, of course, was a very scary period. But from our work at that time, we were advising our clients to stay in the markets. And if you paid attention to the weekly, we'll get into this, as opposed to the daily, it did close the week above the 50 and you would have stayed with the stock. So here is another example of a very extended period. This was the company reported strong earnings. The markets loved it. But you would not have been well served to buy it when it's that stretched and away from that 10-day moving average. I'm pointing out here Clinton's comments, but again, if you pay attention to the longer term trend, you would have stayed in this stock and experienced indeed another nice move. So let's go ahead and take a look at a different example. This is GPN, Global Payments, and what we are looking at here is a weekly chart. And again, your 50-day now becomes your 10-week, and the blue line is your 200-day or your 40-week. So we're keeping the metrics the same, but now each bar represents 1 week. So here we're taking you back to this horrific period, the beginning of this year. The stock breaks down with the broader markets. But what I wanted to point out here is, and this would be certainly for another webinar, but this is a classic reversal where it undercuts the previous low and closes in the upper portion of its trading range on volume. But it is the beginning of a reversal uptrend. So now we have a stock that, after breaking above this 200 and above the 50-day moving average, the stock is now finding support. And the same principle applies where when it gets really extended above that 50-day, you don't want to chase it. Indeed, it does tend to come back. But the bigger point is, now after the reversal, we have a stock that is continuing to find support at a now upward trending 50-day moving average. The other thing I wanted to point out is, going back historically, you really want to, I talked about the slope. There are periods where the 50-day will trend sideways, and quite frankly, oftentimes you're better served putting your money to work elsewhere. But it's really during this very, very upward sloping time period that you want to be in a stock. And both key moving averages are in very clear-cut uptrends. You want to match that with the fundamentals. The company's continuing to come in with strong earnings. Each of these big bars are earnings releases. So again, to pay attention, look at that slope. That's going to be a strong winning stock. Pardon me. So what we are looking at again is using that longer term trend line to keep you in a stock. So in particular, we're looking at a more recent chart taking you into the close. Well, actually it's today. And so the stock breaks down. This is that Brexit. I talked to you about how it did find support at that 200-day moving average. So ideally, if you are paying attention to that bigger picture longer term, it would have kept you in the stock. Now, more recently on the right side, it is experiencing that phenomenon that I talked about where your 50-day has leveled off, flattened out, interest in the stock has diminished, so it's really just in a trading range. Again, this is the type of slope that you want to see to tell you that this stock is in a clear-cut uptrend, and if you own it, you want to stay with it for that uptrend period. So let's go ahead, and we're talking uptrends. Here is an example of using the 200-day moving average for a sell signal. So what we're looking at here is Mattel. It's a weekly chart, so each bar here represents 1 week of trading. And I'm taking you back actually to May of 2013. This is a longer term chart. And what I wanted to point out to you here is a stock that prior to this had been doing quite well, but here we have it's finding upward support at an upward trending 50-day moving average, but this break here, as it breaks below the 50-day, is your first warning sign. I mentioned to you before, you'll see this with the 10-day, but when it breaks the 50-day, it's a bit more ominous. So now we've broken that 50-day. If you go down here, you can see it was on a little bit above average volume. Some traders would stay and wait to see if it finds support at the 200-day, but realistically, your 200-day has lost its upward slope. So and then also, we're not going to review it here, but there are other technical indicators that you can marry with the moving average that will give you even more confidence to pay attention. But reviewing strictly this price and volume chart with these moving averages, I will tell you that once it breaks the 200, if you've waited around, this is for sure when you want to exit the stock, because take a look at this volume as it breaks that 200-day, huge volume, and definitely again and again, chart after chart, you don't want to be in a stock when it breaks that 200 on big volume. And sure enough, it was a precursor to not good things ahead. The stock continued to break down. So let's take a look at what we've seen. We see the breakdown, 50 warning sign, 200 you need to exit. But now take a look at these moving averages and you'll see the slope. Very, very clear-cut downtrend. I talked about the golden cross. When you have a shorter term crossing down below a longer term, that's a death cross. So as you can imagine, it's quite the opposite. So we did have that death cross. Now take a look at what happens. This was acting as support. Now you have a stock that every time it tries to trade up, it is finding this once area of support now becomes resistance. And as long as this downtrend is in play with your particular stock, it's going to be finding resistance at a lower and lower level. So again, this once area that was a floor and acted as support now becomes a ceiling. And hopefully you can see just how heavy this pattern is. Your key moving averages are trending down. Every time it tries to trade up, it gets knocked back down. So in this particular instance, I'm taking you to the first quarter in 2015. The company managed to come out with pretty decent earnings, and the stock appears to perhaps it reversed. Look at this volume. It's up through the 50. It's up through the 200. Well, not so fast, because take a look at these key moving averages. They're still in a severe downtrend. So looking at just the slope will keep you out of these reversals, or the head fake reversals. I'll show you in our later examples when it is a true reversal. But and then also your 50-day has not crossed up above it, this 200, to confirm the uptrend. And actually we do. So here we have a true reversal. So take a look at the stock price breaking back above the 50, above the 200. Now take a look at what's happening here. Your 200-day is leveling off. Your 50-day, similar to here, is in an uptrend, but now it's that golden cross. So what you'll find is that's going to trade upward. It's going to help eventually pull your 200-day back into an uptrend. And so again, we experience that period where this 50-day, instead of being a ceiling during this downtrend, again reverts back to becoming a floor, an area of support. So in just this one example, you can get a feel for not only how the slope of that moving average is, but how your stock the moving average can act as resistance or as support. So let's take a look at another stock, and in this particular instance, it's AT&T. This is a daily chart, and I want to show you how to use moving averages to help you spot strength in a stock. So what we are looking at for AT&T, and a lot of these stocks, ISRG, AT&T, these are stocks that have made it to our buy list because of various attributes that I'm reviewing with you right now. So we picked this AT&T up because, as you may recall, again, the beginning of 2016 was a very, very tough period for the markets, and most of the markets were in steep downtrends and sell-offs. But we noticed that AT&T was just kind of trending sideways. It really wasn't getting hit that hard. So again, you can see this is the beginning of 2016, and the stock is just bouncing around here, almost ignoring what's going on with the broader markets. And so you have these moving averages in clear-cut uptrends. As the stock breaks out, it does so on big volume, and you can see again that it's finding support. Let me just see what we have. Well, we'll review that chart again, but what I did want to point out to you is here's a chart of the S&P during that very same period, and you can see that really horrible sell-off while AT&T was just moving along as if nothing was really going on. So here's AT&T again, that daily time period, and below it is an line chart of the S&P during that same period. So what I wanted to point out to you is the stock was finding support at an upward trending 10-day, and that's going to tell you that this stock is strong, and that when market pressure finally is relieved, this would indeed be a winner, as it was. You can see that that AT&T went on to experience a very nice move, and this was again one that we picked up back in that January period, and we put it on our buy list. But let's take a look at what it's happened since, because it is no longer on our list, and you can see why. But before that, again, this is daily, so this is your 10-day, the green. The 50 is your red, and then the blue is, in this case, a 100-day. So again, very simply, you can see how it's finding support in an upward trending 10-day. But here's your first sign that things might be near-term slowing down as far as the price uptrend. So during this time period in July and August, notice how this 10-day kind of levels off. And it's not a reason to sell, but it is something that you can use as a signal that the stock is tired, for lack of a better word. But of course, this is when you would dig into the fundamentals to see if anything has shifted. And again, now over here we have a break below that short-term moving average, and it's occurring on very, very big volume. So we're seeing this break down below, and so this again is very ominous. As it breaks its 50-day, it's all happening on very big volume. I will say, during this period, what we were experiencing was a move away from these AT&T, Verizon, these stocks that were providing huge yields for investors. There was a move, and still is, into growth stocks. You know, this is when we started to see the NASDAQ outperform. So as sector shifts occur, you'll see this type of breakdown. And then again, of course, it breaks that 200-day again on very, very big volume. So this is an example of when you can spot a strong uptrend potentially ending and then reversing. Here's another example, and what we're looking at here is NEE, which is Next Era Energy. Utility stocks have been in the top 3 performers year to date. They have done very, very well. And we're looking at a weekly chart here. I am not able to see. Oh, here we are. Okay. So what we're looking at here is the stock. I wanted to point out to you, when you're looking at, and institutions do primarily use weekly charts. They're not, portfolio managers are not watching the market every tick and every day. So they want to see how it closes at the end of the week. And that can really be helpful if you have a longer term horizon in your investing, because oftentimes you will see periods such as this where the stock breaks below the 50, but it actually closes above, that week above the 50-day. And likewise, the following week we had a break, but the stock closed above that 50-day, above that upward trending 50-day. So if you do, again, have a more medium-term, longer-term outlook on your investing, you will want to not get shaken out intra-week. You will wait to see how the stock closes at the end of the week, and oftentimes if they are a strong stock and it's selling off potentially on a rumor, it will close back above and then resume that uptrend. So that's how, again, using a weekly chart so that you don't get shaken out. Let me just... So I talked earlier about how you can use moving averages when trying to determine the health or weakness of the broader markets. And this is critical because, of course, you don't want to put money to work in a market that is not strong or in an uptrend. So this is a weekly chart. tend to use weeklies for the broader indexes because the daily, it whips around quite a bit. So this weekly chart is, the red is your 50 and the blue is the 200-day moving average. And I talked about this before. This is that 2013 through 2015 period. And for the most part, the general trend is and has been up. This, of course, was a very tough period at the end of 2014, but your key moving averages were still trending upward. But here's where it got a bit ominous, and this is going to take you back to last summer. So you had a couple of things occurring. Your 50-day is starting to trend sideways, and it's exhibiting tiredness, for lack of a better word. And unlike this prior breakdown, we have this death cross. The 50 goes down below the 200, tremendous volume. So this is signaling that all is not well in the broader markets. And while we only had a correction, it did not get to a bear phase. If you look at this, for the most part, you were not paid to be in this market, although we did have, this was a period when some consumer stocks were really outpacing. You could have had pockets of moves, but for the most part, the markets were in trouble. Your longer term trends are going down, and then of course it culminates with this huge break in the beginning of 2016. So hopefully you're able to notice the change relative to this more recent breakdown as your key trends are down, your death cross, your 50 never gets back up, and so it's just a heavier downtrend pattern as opposed to that 2014 break at the end of that year where it was, your 50 did not get close to the 200, and indeed it was able to resume that uptrend. And so let's take a look and review what we have been going over here today. How can you as an individual or self-directed, how can you use these moving averages? And so we talk about using the 10-day moving average to identify buy points. And so I tend to use that 10-day. The stocks that I traffic in are high growth. I'm looking for big winning stocks. So looking at that 10-day and not purchasing a stock that's extended well above that is going to be really very helpful. And it's the kind of thing that you can screen, you can put it on as an alert on your stock watch list, and pay attention to the where the price is relative to that key moving average. And the second is what we just reviewed, and that is using broader market 50 and 200-day moving averages as a guide so that you don't get whipped around. That's going to be really very, very helpful for you, again, because that broader market, you do want the uptrend to be in place. You want the wind behind your sails before you get into a particular stock. That golden cross for the uptrend and then the death cross for the downtrend, a lot of trading platforms have that metric in there, and it's something that you can screen for. It may not be named that, so what you can do is screen saying if the 10-day crosses below or above the 50, or if that 50-day moving average trades below or above the 200. That's how you're going to screen for those crossovers, which are very, very helpful. And then lastly, using weekly metrics, and I'm not trying to change the way any of you invest, but I will say that for longer term, those traders that are looking to stay in a particular stock, that weekly chart is going to be quite a bit more useful because you're using longer term metrics to make your decision and you're not getting whipped around. But again, daily charts and getting in and out, even intraday, using a 5-day chart, the same principles are going to apply when using these moving averages. So, really, there's no right or wrong way to make money in these markets, but there are different averages you're going to want to use for different metrics and different time periods. So we can take a look now at some conclusions after reviewing all of this. I hope that you've gotten quite clearly how important moving averages, what an important tool they really are when analyzing your stocks. And again, I pointed this out earlier, when you can combine this with other technical metrics, you'll really be in a very strong position to trade stocks. And I talked a bit about this as well. You want to look at historically how your stock has behaved around a key moving average. And it's really surprising how it will be helpful as a guide for how the stock will perform going forward. Again, I've noticed stocks do tend to have personalities. They have key moving averages that they tend to obey, for lack of a better word. This third item, know yourself. So if you are devoted and you have the time, definitely do the screening. I mentioned to you how you can screen for stocks relative, their price currently relative to their key moving averages, and there's a lot you can do. Also visually, if you take the time, go over these charts, you'll really be able to put in your mind's eye, is it in an uptrend? Is it finding support? Or is the stock in a downtrend? But if you don't have the time, you would be served to subscribe to a newsletter from a seasoned pro that will do the work for you. I certainly do a lot of my work with key moving averages, and each week when we add or move a stock, we mark that chart up and we tell you why. So you can see, are those moving averages in an uptrend? Is the stock breaking out of a base? Are the fundamentals there? So it's a great educational tool, is what I'm saying. So I mentioned at the end we would have a special offer, and what I did want to tell you or provide you with the opportunity to become a MEM Edge member. So the report that I put out each week is the MEM Edge report. Currently, investors are paying $97 a month, but what you can do if you would like to try it out is for $7 you can get the next 4 weeks, and you will receive the weekly report as well as a mid-week report. It provides a big detailed analysis of the broader markets, where the markets are, where the strength is in the markets, and where we see the markets heading over the near as well as long term. There is a weekly updated report of stocks that are currently on our suggested holdings list, and it notes the performance of those stocks. Each week, I will say on average, we have stocks that are up. This week we have several that are up 4%. Last week, 2 of them were up 7%. So we do have stocks on our list currently. It has gotten as big as large as 18 on our suggested holdings. Each week we highlight and italicize those that are in buy zones. The list has been shortened a bit with the recent volatility, but it's still a very vibrant list. And so I wanted to offer you the opportunity to take a look. This is an incredible opportunity for those that, again, want to educate yourself further and get in front of these potential winning stocks. So there is a link highlighted there in yellow, and you'll want to go ahead and go to that link to take advantage of that offer. And of course, you can always visit my website and email. My email is listed there at the bottom for anyone, but why don't we go ahead now. I forgot to mention that we're going to go ahead and do some questions and answers. So for anyone that has any questions, I'm apologizing. I do see some questions already in here. I should have mentioned that we would be saving those questions to the end, but let's go ahead and review some of these. The first one is, do the moving averages that you use only work for stocks, or would they work on FX as well? I do not have, I don't trade foreign exchange, so I apologize. I don't have an answer for that, but I will review that and get back to you on that. So someone else asked to please talk about the relationship between the time frame and the moving average and the price. So I did go over that. Hopefully that question was answered. So your shorter term, your daily, you will look at a 10-day and a 50-day versus the weekly. And Leon, you also asked 10 and 40. Why using, okay, so I think you asked about the 40 instead of 50. The 40 is 40 weeks when you're looking at the weekly, and that's equal to a 200-day. And then the 10-day is, instead of 9, I have found 10 to be more useful, but again, each person, you will find a moving average for you. The EMA, that 9-day may be more useful, but this is, for me, over my many, many years, what I've found. Let's see. Oh, Robert, you're asking about RSI. That's something that I cover very, very extensively in another How to Read Charts, and you'll be getting an email about that. That's a webinar that's coming up next, the beginning of next week. So if you stay tuned for that, you'll get that, and it talks about using it in conjunction with moving averages. So Rashid, you say you only trade intraday, and you do use the 10, 15, 200. A reliable pattern on intraday, and I mentioned this, there are traders that use a 5-day EMA on that intraday, and that's going to be quite helpful, and that's using the 1-hour chart. Amir, you are at work. Yes, you will get a copy. I'm sorry, you said that you were unable to, you would like to get a copy. Yes, you will receive a copy of this webinar for future use. Monthly, and that was a great question, Leon, when to use monthly. Monthly is really useful for larger cap, bigger trending stocks, and for that monthly, you'll want to use 6 month. And I should have put an example in there. For any of you in front of your screens now, you can take a look at Apple on a monthly and put that 6 month in there, and it kind of presents a pretty interesting picture. Unfortunately, the fundamentals for Apple are a little bit weak, but you'll see what I mean by up versus down trends on the monthly. And yes, do I give a list of stocks? I do. I have a list of stocks that are have been added to the suggested holdings list, and then they are either highlighted or italicized as being in current buy zones versus just being in a period of back and fill. Some of the more explosive stocks will be highlighted as advising that you wait for a pullback before entry. So yeah, all that is on there. EMAs, Alan, yeah, I don't use those, again, simply because from my work over the years, I have found the simple moving average to be quite a bit more effective. It doesn't mean that the EMA has no place. For the shorter term, yes, it does. Intraday, you want that EMA, but I use other indicators that have EMA in there as part of their calculation. For instance, the MACD is one, and so I'm getting that EMA, but just not for that simple moving average. JQ, you're asking about a 4-day, and it's not something I use, but perhaps for an intraday chart. It's the kind of thing with these moving averages where you can go ahead and put that moving average in and go through charts and looking at them, looking at charts that have been winners, recent winners, and NVIDIA, ISRG, has that 4-day, in your case, been useful on an intraday. What I'm presenting to you is what I've found useful over many, many years of going through many charts. But it's, again, you'll find different. MA on a monthly, I did just mention it, but I'll tell you it's 6. Does this duplicate IBD or leaderboard? A very good question, Robert. I don't subscribe to leaderboards, so I cannot answer that, but I will tell you that I read IBD periodically. What I have found is I will put names on my suggested holdings list, and subsequent to that they will trickle in, and I'll start seeing them. For instance, if you were to get my list today, I think 4 or 5 of my names are up at the front of that IBD 50, but they were nowhere to be found on that list when I first put them on. But there certainly is synergy. I highly doubt that there's a direct correlation, but there will be symmetry. Do I use pre-market data? I'll tell you, pre-market data can be useful, sometimes particularly around earnings season, but I would have to probably say no. For the suggested holdings list, I do look at daily, I look at weekly. It's not going to be quite as, for my own trading, I'll use the pre-market just to see, are any of the stocks on my list in potential trouble for any report that may have come out overnight. Now, how much do you use volume change? Alan, that's a great question. I did touch on that in the very beginning. Volume is critical, particularly during breakdowns or breakups through these key moving averages, because when it occurs on big volume, we pointed it out on several of the examples, it's a very much more critical occurrence, both on the positive side as a stock breaks up, or negative as the stock breaks down. If you see that volume, again, that's telling you institutions are in there, and by and large, those institutions are what I would call smarter money. They move the markets. They do have a little more information. So yes, you want to see volume. That's critical. And then reading candlestick like Steve Bigelow. Yes, very good. You can see I used that with all of my examples. It's a great, wonderful tool. And with someone like Steve, you will learn even more as far as how each of these candlesticks can form certain patterns and how you can use those to your advantage. So yes, candlestick is very important. Yes, so you're talking about doji and hammers and so forth. Yes, all of that can be definitely integrated into your trading system and can be very, very powerful. And so here's another question. Even with the moving average, do you get other supporting confirming data? And I did talk about that. Yes, so for instance, your RSI or MACD, there are some traders that use stochastics, but that is very similar to MACD, so that MACD is a more general, something that most people can trade for. And yes, I will use that in conjunction. And then, if 2 or 3 of these indicators are signaling positive, that is going to be very, very powerful and effective for you as a trader. Another question, whether it's recorded. Yes, it is recorded, and you will get a recording of this particular webinar. And so that's I believe the end of our questions. I mentioned if anyone has additional questions you haven't thought of, you can email me, and either myself or someone from our team will get back to you. Another question about using Fibonacci. Yes, I mean that, again, it's not something I use religiously, but I have found it to be quite useful, primarily for the S&P and broader markets, using Fibonacci to identify potential support. In particular, when the broader markets, if they sell off, that's very useful. Yes, and some say only to use moving averages in momentum cycles. I would strongly argue that. As I said, I've been in many different cycles, booms, busts, and so forth. And even during that bear market after the 99 bubble from 01 to 03, that period, there were stocks that were working, educational stocks, alcohol stocks, gambling, and using these moving averages, got in front of people that weren't comfortable shorting. They wanted to be long stocks. So I would argue that absolutely they have a place in every cycle, no doubt. And one other question. Support and resistance. I'm not quite sure what that means, but again, regardless of the cycle that we are in, those moving averages are very, very key in helping. And let's see. So the previous question: use only moving averages in momentum versus support and resistance. Well, I use moving averages to signal support or resistance, and I'm thinking maybe I'm not clear on your question, but using moving averages to determine whether a stock or the markets are finding support or resistance is useful no matter whether we are in a momentum cycle or not. So I think that is the end of our questions. And I do want to thank everyone for taking the time. I hope you'll take advantage of this offer. It's not very often, and would love to see you take a look at our work. And I hope everyone has a good afternoon, a good evening, and take care.